record function. All right, we're officially live. So anyone else could catch up after the fact. Just to recap what we went through last time, we covered some concepts that are a little bit more than basic. And today we're going to keep on that same rotation. We're going to talk about portfolio management, specifically diversification. Raise your hand if you've at least heard the term diversification. You never heard it, Lee? All right. Well, diversification is just putting your portfolio in a place where it's not all at risk. It's just basically managing your risk. So you do that by splitting your portfolio up between different areas. For example, maybe having like 5% of your portfolio in gold, having 5% of your portfolio in real estate, doing some in stocks, doing some in bonds, and the reason you do this is that not all these assets will crash at the same time when they crash. That way, whenever you actually need money from one of these particular avenues, it's there available for you because it hasn't crashed. The one that's keeps its value the most longer than anything has been gold this far. Bitcoin supposedly is going to be the new gold in the future, but Bitcoin is still not widely accepted places. Not only that, Bitcoin also has a lot of competition. You have ones like XRP, Ethereum. Like you have all these different types of cryptocurrencies that are all competing to take that number one spot. But gold, for example, like it doesn't lose value at all. It actually gains value. And I'm talking about physical gold because they sell the physical coins. You could buy them now. I believe they just increased to one coin equals $1,800. So, and that's from like an official Federal Reserve coin distributor, the distributor that'll send them to you. But a lot of people keep that physical gold because unlike the dollar, where every year there's deflation or inflation, which causes the dollar to either rise or fall, that doesn't happen with gold. Gold, little by little, keeps its currency because it's something physical, if that makes sense. The dollar is just a piece of paper that you can.
So I got a question on that because I had a friend of mine. This is like probably about 2 years ago or so. I met him in 3, and he's like I don't think he's big. Well, I'm not really sure if he's big in like trading stocks, things of that nature. But he had like no crap, like a safe, like of like official gold that he's been like gold and silver that he's been like accumulating throughout the years. And I guess I could say I was thinking he was a little crazy because he was like one day when this paper and he pulled out a wad of money. He's like, when this paper don't mean shit, he's like, I'm gonna cash in with all of this stuff and then get, basically like that's how I'm gonna have my currency, I guess. Now, was he way off or was he kind of like in the middle or is he like way left with this?
Nah, he's in the middle because uh, the fact that the whole economy would crash in our lifetimes is kind of not realistic. Especially with like right now we print money like it's nothing. Like during this whole coronavirus crisis, the government has been printing money, like literally getting money out of thin air. That's where you got your stimulus check from. It was something the Federal Reserve, they just created money out of nowhere and they put it into your pockets. They did it. They're doing it for the airlines. They're doing it for all that. So long term.
So if we have some sort of like a bailout or something or whatever you want to call it, right? But we're making money out of thin air. Why do we have? And I know it's like ties into like the World Bank. And if I'm going like way to the right with this like conversation, please cut me off and we can talk about it at some other time. But not to take away from like what you're trying to teach here, but if that's the case, right, where we can just print money and things like that, why do we have a deficit of trillions of dollars, and why do we owe so much money to these people? Why can't we just like be like, all right, Fabrice Brothers, fresh start?
Because that printing money that we're doing and creating money out of nowhere is basically like a loan that we're taking out. because if we don't, then like think about it, all these other places in the world, not just the United States, all these other countries, the dollar is what they run off of. Does that make sense? So
Yeah.
even oil, which is a big deal right now, oil is run off the petrodollar, and the petrodollar is a derivative of the American dollar. So the American dollar is all us. So when we're doing that and printing money out of whack, it's throwing off the whole world balance economy off out of whack as well.
Makes sense.
So
Okay.
so we're not really in deficit to other people. We're in deficit like to ourselves, to our central bank. And
Okay.
the reason we have to pay that back is because if not, it just puts us into like a situation where we're throwing off the balance of equality in the currency. And the more of it is, the more of the fake money that's printed out is out there, it reduces the power of the dollar significantly. So the more we pay back, it increases the power of the dollar.
Okay.
Um, so what's helping us out right now is that we're not the only ones doing this right now. Like the UK is bailing their people out, Japan has bailed their people out, China is doing it. You know, everybody in the world is doing it simultaneously. So
Makes sense.
yeah, so but what we have here is like we have two different entities that are helping us out through this financial crisis. We have the Federal Reserve, and we also have the government, the Treasury. So the Treasury, like we talked about last time, they changed the percentages of interest rates and APRs and all of that. So like they're trying to help us out with by reducing the amount it takes to pull out a loan. That way more people will feel more confident in pulling out the loan. And it also um, increases the amount, decrease the amount people have to pay back over the lifetime of their loan. That makes sense. But it also discourages saving because like it also reduces the quantity of your savings account or your checking account, that percentage that you get every month for having that money in your savings or checkings account, it gets reduced as well. So it discourages saving. You get nothing out of saving. So that going back to gold, gold doesn't reduce like that. Gold is gold is not backed by anything. Gold is itself. If you really want to get into it, like historically, back into like Ronald Reagan, our dollar used to be backed by gold, um, and Ronald Reagan removed that. But that's like now we're going way far to the right. So
Yeah, I appreciate it, and I'm sorry, guys, for freaking like going down the rabbit hole. We can now get back on track here.
all right, so going back to the diversification, what the biggest thing you have to do, especially when you're managing your own portfolio, or maybe one day you'll be managing other people's portfolios, is you don't want to have, let's just talk about stocks, for example. You don't want to have a lot of stocks we're going to talk about correlation. All right. So the goal is to have the least amount of correlation between all of your stocks. All right. So correlation, what is correlation? Basically, in a nutshell, it means if, let's say I have these two stocks at the same time, um, when one goes up in value, and what does the other stock do? That's where the correlation comes into play. The very simplest way of putting it is there's, I could write this down here, make it more visual. All right. All right, so there's formulas, there's like very complicated ways of going into this, and you guys can go through all that, or later on as we progress, we could go through them, but there's like formulas that can get this down to the very T. But the very simplest form of this is so these are the three most simplest ones. All right, so when you have a 1.0, that means All right, so when you have a 1.0, that means they are 100% correlated. That means both of these stocks move in unison. So just think about what the stocks that you have currently in your portfolio. Think about what's the purpose of having both of these stocks, having 5 shares here and 5 shares here, when both of these stocks are going to do the exact same thing all the time. Uh, if you have all your money in those two stocks, if that even if they could be in different sectors, like one could be in the like oil sector, energy sector, and one could be in the technology sector. But these two stocks, if one goes up, the other one goes up, one goes down, the other one goes down. When something like this happens and the market crashes, you're going to go down on both of those stocks at the same time. So no relationship means that like they don't interact with each other at all. Like one goes up one day, the other one goes up one day, one goes down, the other one goes up the same day. Like they do different stuff. They're not correlated at all. And zero correlation means if the stock is going up, the other stock is going down every single time. Am I losing anybody?
So when you figure this out, or how do you figure this out? Is this through research, or is this through is there something that says that does that?
You could go through their charts. That's I guess, the simplest way of doing it. Like finding somewhere on the internet where you could compare both of the stocks side by side, and you can see what they've done historically together. The relationships could change. Like just because they were correlated in 2017 doesn't mean they're correlated in 2020. But you want to look at the most recent historical data and see what have these stocks have been doing. Uh, Things that have like the least amount of correlation together are things like uh, stocks and bonds. So that's why as you get older, what hedge fund managers do is they reduce the amount of risk you have by taking the percentage of stocks you have and moving a lot of that percentage into bonds. And the closer you get to retirement, you'll have like you used to have 80% stocks and 20% bonds, and now you have 90% bonds and 10% stocks because you're getting ready to get out. And that's why they do that, because of the correlation between stocks and bonds. So bonds are a lot less riskier as well.
So would
Yeah,
you say
makes
is
sense.
correlation is bad for the most part, I guess? Or would you like recommend having no correlation?
Well, it's kind of hard to have zero correlation, especially right now in the situation we're going through, because as you look through the daily charts of like the like the average, like even stocks that don't have a reason to be going down right now are going down. There's companies that are thriving during this period, but just because the rest of the stock market is going down, their stock price is going down as well. There's companies that are like excelling, like Chipotle, for example. They started doing like takeout delivery, and they're actually delivering to people's houses and stuff. So like there was a time when this first started when they were already doing that, and their stock price dropped significantly with everybody else for no particular reason. Um, and you got to find those stocks right now that they're down for no particular reason, but you shouldn't be going and buying two of the same type of stocks. um, Another way to put this is like do you guys have index funds, like,
No, not that I know of. I don't think so, no, actually.
or ETFs?
I don't think so.
No,
I
but
was looking into it, but I haven't invested in it yet.
all right. So that's another problem that people get into, is like they don't research the ETFs that they get. So for example, uh, they'll get one that says, technology sector, and then they'll get the S&P 500 ETF. So it's two different ETFs, right? um, the technology ETF may have like 50 companies in it, and the S&P 500 ETF has like 500 companies in it, obviously. um, and then they don't go and look at what companies are in, like, all that information is out there. You just have to like go and research exactly what's in that ETF that you're like. You can look at every single company and it'll tell you what percentage of the fund goes into each one of those stocks. So like the Vanguard ETF, for example. Matter of fact, let me share this.
And then another thing I was just thinking, so for correlation, right?
Yeah.
Freaking, in a way, couldn't it be good as well? So, for example, I'm investing in AutoZone and O'Reilly Auto Parts. Now they're both like automobile, I guess, essential, parts and whatnot for the most part. And I say I do have 5 stocks in AutoZone and O'Reilly. Essentially, that's 10, but like it's doubling. So if they're both up, then like I'm up on both. But then if they are both down, obviously I'm down on both.
Yeah.
But if I do have both, I mean, like essentially I did just like kind of double it rather than just having 5 stocks in one.
Yeah, but if you would have had all that money in one, it would have done the exact same thing in that one stock. Does that
That's
make
true.
sense?
Yeah.
So,
Yeah.
let me share this. Please let me know if y'all can see this. Can y'all
Yeah, we see it.
Y'all see it? All right. So let's go to Voo.
The hell's that? Midget what?
What?
Typed in porn and it said Pornhub / midget porn.
Wait, what? All right. So let me see. So you come. This is one place you could look at. This is the Vanguard S&P 500 ETF. All right. So you could come here, and this will give you. People don't come and even look at this. They just say, "Oh, I heard this was a good one. Let me get it." But they don't go in there and investigate what exactly they're getting. So you have to come in here and like actually start looking through this and see, all right, what am I looking at? All right, so what's in here? So this right here is going to show you at least the top 10 holdings. So the top 10 holdings of this is you have Microsoft that has 5.58% and Apple at 4.93% in here. Hey, can one of y'all turn off your microphone? I think it's Lee. All right, thanks. All right, so you have, you go to here and you see, all right, Microsoft and Apple, but then let's see if this is one. So this is another title. And you're like, I'm going to diversify. Let me see if this one would work. And you're like, I'm going to diversify and I'm going to get VOO, and then I'm going to also get VGT, which is the Vanguard Information Technology Index Fund. But then they don't come down here and realize that like they're already doing Microsoft and Apple in that other ETF. And now they're going to come in here and do even more Microsoft and Apple, because here you can see that the percentage in that fund that is Microsoft is 18.51 and Apple is 18.30. So they're already invested in Microsoft and Apple in the VOO ETF, if that makes sense. So that's one thing you guys got to look at, especially if you're going to start getting into ETFs, because you don't want to get into one ETF that has the same exact things as another one. Another thing that Vanguard does is they break their stuff down. They also have ETFs that just have like specific sectors of the, like, so you won't have the same companies, because you'll have, this is a healthcare ETF, this is financial ETF, this is the consumer. So these kind of break it up so you won't have to do it. The reason they do that is because not everybody wants to have the whole S&P 500. Some of them just want the technology sector, but some people will get the technology sector, they'll have VOO, and then they'll also have Apple stock and Microsoft stock. So they're just like, they have the same two companies in like 3 different places in their portfolio.
Also, doesn't that like you showed us last week, where like let's say you had VO and you had whatever Vanguard, and they're basically the same, but then for example VO or the other one might, for every $1,000 you invest, might have a higher interest rate or whatever it is that they take away for every $1,000 that you spend, like whatever the percentage is.
Yep. So yeah, they also have the fees that come along with the ETFs. So let's just say it on here. Yeah, so for this one, this is the bond ETF. I'm going to reduce the screen of your faces. Yeah, so if you come here, you'll see it right here, expense ratio. This is how much you're going to pay just to hold this ETF. So that's for every $1,000, that's $1.50 that you're going to pay. And you'll pay that quarterly. But quarterly, you'll also receive a dividend, which that dividend is 3.25%, which is higher than most banks have. And this is a bond. So bonds, like I said, they're usually the safer bet, and they have a zero correlation or a negative correlation to stocks, because when bonds are up, stocks are down, and vice versa.
Excuse my ignorance, but what is like a bond? And I mean, I just don't fully understand. I know it could probably be a simple Google search, but I don't know. I don't understand what like certain things are.
All right, so there's different types of bonds. There's a bond is just you lending the money to a particular person, or there's municipal bonds as well, where you're lending money to the government of a particular place. So look up specific definition. Yeah, so it's basically a promissory note that for a certain amount of time, you're going to lend this money to a particular person or company or municipal, which is like a state or the federal government. You're going to lend them money and they'll pay you back, but they'll also give you like a yield every so often.
Okay,
So
that makes sense.
municipal bonds are like the most popular ones because they help you with taxes as well. So municipal bond, a security issued by or on behalf of a local authority. Yeah, baby. Are municipal bonds a good investment? Investing in municipal bonds is a good way to preserve capital while generating interest. Most of them are exempt from federal taxes, and some are tax-free at the state and local level. Munis are often considered a separate asset class, so it pays to know the muni bond basics. So that's one type. Then you have the opposite of a legit opposite of a stock is a corporate bond. So a corporate bond is issued by a corporation in order to raise financing for a variety of reasons, such as ongoing operations, M&A, or to expand businesses. The term is usually applied to a longer term debt interest with maturity of at least 1 year. The difference between a corporate bond or a corporate stock is stocks are traded on the exchange and corporate bonds are not traded. This is like an agreement between you and that company that you're going to pay. And these are a lot riskier than the municipal bond, because the corporate bond, the company could go under, whereas the municipal bond, like the chances that the state is going to go under is very low. Does it happen? Yes, it does happen. Detroit would be like a big example of where it went wrong, because like the whole, even till now, Detroit is like a wasteland. So does that answer your question? At least
Yeah, it does. It makes sense too.
Yeah, there's different types of bonds, but these are just a safer bet. The reason people just don't go to these is that the yields are really low, especially now. There was a time when the yields were really high in bonds, so it was like, a place you wanted to be, but the rate of return is a lot lower than just having it in your bank account. Let's see if they even have a corporate bond rate. Let's see. The payment amount is calculated percentage, blah, blah, blah. No, it doesn't really tell me. I guess it won't tell you because IRS measures corporate bond returns on monthly year to date. IRS reports a 6.14 average weighted corporate bond interest rate. And the other issue with corporate bonds is not every company is going to allow people like you and me to purchase the corporate bond. Like they don't want your $100. That's not really going to help them out. They really sell corporate bonds to like millionaires or people who are going to actually invest hundreds of thousands or millions of dollars and get that back security from that corporation. But yeah, the municipal bond a lot is very popular because you get that money, you get that return from the government, and it's more guaranteed because it's actually from it's not from a company, it's from a government. The Another reason people don't really stick to the bonds is that you have to stick to that date. So whereas like a money market account is like a 1 year obligation, uh, bonds you have like 2 year bond, you have the 10 year bond, you have a 20 year bond, you have 30 year bond. So your money has to be in these securities for that long.
Yeah, so you gotta be balling pretty much, like you said, to jump into these corporate bonds and things
Yeah.
like that.
So um, let's see. So this is what the yields are at right now, and these are tracked on the stock exchange as well because you know, um, they have a relationship with stocks. So the 10 year and the 2 year are the one people mostly look at. Like, what is this yield? Starting like in January, this yield was above 1%, and like people were like, this will never be below 1%, and it's dropped a lot. Um, so then you have the 10 year. So this is basically telling you that for a bond, you're gonna put it in there and only get 1.3% back on your money you put in the 10 year bond, and you can't touch that money for 10 years. So at the end of the 10 years, you're not getting um, like uh, a more money on your money. That's all you're getting, that 1.3% on your return. So if you put 10,000 in there, I mean, y'all could do the math.
For the percent, so does it have to be a set amount of money that you're putting in, or can I put in 100 and then like keep putting in more money over time?
No,
Or is it
a bond is a one-time thing. So when you get the bond, let me see if they have.
if I put in 500, that's as much as I can put in until that 2 years is over,
Yeah,
or 10.
and they usually don't issue them like in 500s, but you'll get something like this. So this is like you'll get a piece of paper like this, and it'll have the whole like all the information of your transaction with them. Um, so this is a 500 one, but this is like, it looks old as hell, like a really old bond. Yeah, it looks like these are all really old. But yeah, man, you're when you're talking about bonds, you're like at least 1,000. I think they have a $1,200 one. Again, it varies by state because there's even counties. Like some counties will let you purchase a bond from that county, and what they do with that money, what they're supposed to do with that money is take it and invest it into building, like fixing up the roads or putting up street signs, fixing street lights, like all the stuff that it takes to keep that city going. um, and you're just helping that process, but you can't just pull your money out whenever you want. Like it's an obligation, so that they they keep that throughout the 10 year of that obligation. Let's say you have the 10 year note, it's called a note, but let's say you have that 10 year note. They're gonna that for the whole 10 years it'll apply to your taxes though, so you'll get that. um, any percentage you've made is going to get reduced from your taxes. Uh, is that pretty in depth there, D?
Yeah, it answered my
Yeah,
question. And then another question I had, so for the yields, correct? I saw for the 2 year they had the 0.88, I guess, percent yield. Does that ever vary? Or like say I put in my 1,200 at that 0.88 yield or whatever for the most part, will that yield go up or go down at all? And will
Yeah,
that like affect what I get back?
that's a great question, man. Yeah, it's not fixed rates, so um, it's not a fixed rate that you're going to have. So yeah, man, if you buy in at 0.88, 10 years from now, that 0.88 could be a 3.5 or a 5.6. But what happened to a lot of people is the opposite. Like they're in their bonds right now, but their bonds were, let's say, what's today? This is 2020. So let's see, 2010. Let's see. So look at the average, like 2009. These are what the bonds were. So now the people who are, they can't even cash out right now. They went from thinking, oh wow, I have a 10.7% to now they have a 0.88.
You're basically taking a huge risk because you don't know where the economy is going to be in 10 years, for example. So just based off of what you sign on in, let's say, 2009 or 2011, you never know what it's going to be in 2019 or 2021.
Exactly. Not only that, I mean, it was 1291 here. Then this year they would have got this return. Then this year they would have got this return. This year they would have got this return. And these aren't that bad, looking at it. But again, 2020 comes along and you see 0.88, and it's a bad day. It's a bad day for everybody.
So after the bond year is up, let's say you do see a 0.88 return, are you able to keep your bond in longer, or are you forced to I guess withdraw it?
No,
your mark comes up.
Again, it's just a contract. So as soon as that contract expires, if you wanted to reinvest that money, you would just buy a new bond, and you would do it at the new rate, which would be 0.88 if you did it today. And you would do it for either 2 year, 5 year, 10 year, whatever that means. Because not every state is going to offer all of these bonds. Some states will just offer like a 10 year, or some states will just offer the 2 year. So it all depends on the state. But yeah, man, that's the rate of return. You can't extend it. You just would have to repurchase a new bond, because the end of you reached the end of your agreement. Does that make sense?
Yeah, that makes sense. And then, so if I were to be in the States, so where can I go to, I guess, buy in bonds or invest in them?
A lot of the times you just go to your county office in whatever state you're in. I'm not. Let me see. Through the U.S. Treasury Department, you could buy new Treasury bonds online by visiting Treasury Direct. Through a brokerage, you could buy through there, through mutual fund or ETF. And by ETF, that's what we were looking at earlier. The bond ETF fund is like, since bonds can't be traded on the stock exchange, they created ETFs which contain bonds in them, and those are traded on the market. So you can have bonds that have there's even specific bonds that are tax-free bond ETFs. So these are the different ones you could look at. I'm always going to go with Vanguard because Vanguard has like the most competitive rates, but VWITX is the Vanguard Intermediate Tax Exempt Fund. Again, you could put this in your account and have it in there. But at your age, like, you really don't need exposure to this specific thing. But again, you can come to the Vanguard website and they have to give you all this information. So they do. Right here, you can see like what's my risk potential here, and it's very, very low. Whereas I'm sure if you have like a technology one, it would be like very, very high. Let's compare it.
Do you go on Vanguard and do your actual like you purchase it off of Vanguard, or do you go through M1?
I have it. They have all these on M1. So these are called index funds, but Vanguard also offers the ETFs that like they're in direct relationship with the index fund. So let's see.
And with ETFs, I mean, although it says the minimum to buy in is this, but you can continuously add into it, correct or no?
Yeah. The ETF you can just keep buying into it. You could buy you can have as much as you want. So right here, this is the comparison. You go to the technology one, and then you go to it has a level of 5 risk. So
Okay, cool.
these are things y'all should look at. Another thing that people don't really look at a lot is the expense ratios. So you have the expense here, but there's also, let's go look at fees. What do you got for fees? All right, so it shows you what you pay at Vanguard, and then it shows you what you can expect to pay at another company. And then fees on 10,000 invested over 10 years. So in this ETF, 236. In the category average, which means in other companies, the average you would pay on $10,000 in 10 years would be 2,883. So you would save $2,647. And this is like all factual information. Like Vanguard is a highly accredited company. They're not like some low management. Like they were the ones who his name is Bugle. Like he invented the index fund, which later on became, the ETF is the equivalent of the index fund, because index funds can't be traded on the exchange. So they created these ETFs, which can be traded on the exchange. Does that answer your question?
Yes, I ain't gonna lie. When I first heard of people talking about Vanguard, I thought they were talking about like the Chevron company.
So let me see.
So I guess on here though, like you were saying, so whenever you like, let's say I'm gonna purchase an ETF, right? And I'm going with Vanguard, and I'm on M1. Do you recommend I come on here and look, or all the information that's here is also on M1?
Well, M1 is going to give you the basic information. So what you want to come on here, but another thing you do, like after you purchase anything, let me look at you guys for a second. So after you purchase, whether it be a stock or it's a ETF on any platform, but for us, M1 Finance mostly, have you guys received those emails from like the company? It's called prospectus documents. Have you guys seen that?
No.
So
I don't think I have. Only emails that I've received like from the M1 is that like you have the opportunity to vote in that company because like I guess they're about to change something.
You should only get this when you purchase the company for the first time. So let me go on here. Let me see. I'm just looking right here. So it's called prospectus documents. And if you haven't received them, you may have just thought it was something else, but if you haven't, it's mandatory that they deliver them to you. So basically a prospectus document is you just purchased this company. So the company is giving you their prospectus. So you go on here, you click that, it'll pull up a document. And this document, like you should do this for every company you have because it has information on here that people don't ever look at. So you have things here like their annual report. So, how do they do on their annual? And then the big takeaway here is like, it shows you things like risks. It shows you things like fees that you wouldn't think about. So Uh, so right here, for example, on this ETF, this is a developed markets ETF. So you have management fees of 0.04%. You have distribution fee, which is none. You have other expenses, which is 0.01, and total the operates of fund is that the total of that. So the 0.04 plus the 0.01. And then you have an example of here, what your 10,000 would look like after 10 years. It would be $64 that you spend. And then portfolio turnover is something that people don't look at. So, for example, I think I brought it up last week. The S&P 500 included Macy's in it until last month when Macy's was taken off of the S&P 500. So when that happened in the ETF, they removed Macy's as well. And for doing that, you have a portfolio turnover, which you incur a fee because they have to sell a stock and then they have to purchase a whole new stock. So the portfolio turnover rate was 3% over the average value of its portfolio. These are all things y'all should understand. You should come here and see what exactly has this. It shows you what it did throughout the last 10 years. In 2009, it was up, but it was down in 11. It was down in 14. It was down in 21. It was down in 2014. So it gives you the history of it. And I mean, you guys should have these. Like, look through your old emails, because every single time I've purchased the ETF or purchased the stock, I've received the prospectus document.
Okay.
Yeah, but just go through it, man. There's a lot of information. There's even there's risks. So it talks about the risk, like principal risk. An investment fund could lose money over the short or long term. You should expect the fund's share price and total return to fluctuate. Stock market risk, the country risk. So since this ETF right here, it includes different countries in it. It has stocks from a bunch of different countries. It tells you, what risk you have by investing in another company. Another country. What some risks you could have. Currency risks. Because you're dealing in other countries, you're also dealing in different currency. So what's the risk that you're suffering there? And once you have all that and you understand it, you know exactly what you're purchasing and what kind of risk you're taking. I know in the app it looks like a simple, all right, I'm gonna buy and that's it, fire and forget. But you should go and take a look at exactly what your money's doing and where your money's going into. Yeah, do you have any questions on this? Hello? Do you have any questions?
No, I don't have any questions on that.
No. All right.
No questions.
But yeah, if y'all don't have them, y'all should go and email or like contact them through the app and let them know you haven't received prospectus documents, and then they'll send you all the prospectus documents. Let me go on. New share, whiteboard. Clear and draw. All right, so next we're going to talk about, say, LA, New York. All right, so this is the destination that your stock is going, right? It's always going to the right because that's the way time goes. And between here, between, LA and NY, which is like your start destination and your end destination, your plane's going to take off. And this is the stock price. So this is a very simple form, but we're going to talk. As it goes from here to here, the stock is not going to be like a regular plane where it just goes and takes off and, it lands. the stock obviously is going to experience turbulence, and it'll drop and it'll go, and then it'll, hit turbulence, and then it'll go up and it'll drop. Sometimes it'll hit a lot of turbulence, sometimes little. All right. So what I'm getting at here is when we analyze charts, we don't focus on these little areas here. We don't focus on these little spots here as being something significant. We don't look at. We don't look at those little spots there. What we look at is big dips here. And whenever you see a big dip like here or here or this area here, and these become historical markers. Not at the time, because we don't know. We don't really know what's going to happen next. We don't know what's going on, but they become historical areas. So we always look at where it first started. So this area here becomes a trend line. That was a new high and it dropped. So that top area, I'm trying to get it on it, but even with my finger drawing, it's still static. So even here, you draw a line that comes straight across, and that line becomes a new point of reference. So when you see those references, like it could be the ones that are looking at, they become moving averages. So it could be a 50-day moving average, it could be a 100-day moving average, and these spots become places where later on, and historically, they'll become points of resistance or points of support later on down the road. So as you see them and you move down historically, now you'll see that line. It'll be where it provides support, or this line here where it dropped down significantly. It'll become that new place where support, it provides resistance. Does that make sense, Lee? I think you asked about that last time, and I don't think I answered you correctly.
No, sir. A little bit.
Was that you that asked, like, why I was choosing that 2,850 level?
Yes, sir. That was me, sir.
Yeah, so that's, and I have it pulled up here. I have the chart. I just wanted to give you guys a visual there. Let me see. Let me share. All right, so as we come here, let me subtract you guys. So as we come here and we look at the chart, what you guys see down here, these are the levels of volume on these particular days. So they're all on daily. So when you see like this big green bar right here, that means there was this amount of volume on this day, and that volume was also, it ended in a positive. So that's all these lines in the bottom here are. It tells you how much purchases were made on that day, essentially like how much volume power and where we're at. So as you come here, these spots, like these big dips, become points of either support or, depending where the stock is at. We're looking right here at the S&P 500 index. So you could just draw a line like straight through there, and that'll be the line of support. Or you could come up here. This is another line people are looking at. Like once this all keeps going up, you'll see this will become a line that people are looking at for resistance at the top to bounce back down. So currently this was the low right here on the 23rd of March. by looking at this, like, what are your, let me just get your guys' opinions. If you were just looking at this and you saw this was the low and you saw it's been doing this, struggling to get back up, like, what do you think is next for the stock? What do you think is next for this index?
Another drop.
Yeah, and that's what we're, you know, that's what I'm anticipating as well. That's why I'm not bullish. I I did a lot of selling. Like, I did a lot of selling from my regular account, and I just transferred that money into my retirement account, and I've just been holding and holding and holding, just purchasing little by little. And what I did was, before I sold it, I saw uh, what my average buy price was for each of the stocks that I sold. And when I go to my retirement account, I'm going to start buying them again, but I won't buy them unless they're below or at that same level. So I didn't sell anything for a loss. Everything I sold was for a gain, not a major gain, but it was for a gain. The biggest gain I had was from the SPCE. That one I made like 100 and I think $21 when I sold it, uh, which is, it's not much, but I'm thinking about longer term. So yeah, right there. So that 2850, when I brought it to your guys' attention, it was based off that low right there. We see where the finger's pointing. That's where I felt it would hit that, and it did. It dropped, and then the next day it passed it just a little bit. But as you guys can see, like, that 2850 line is still holding really, really strong. So this is where a technical analysis does, you know, it does pay fruit, uh, especially later on if you guys do want to get into like day trading or something like that. Like, this is all they do all day. They try to guess what's going to happen next by looking at um, the historical charts. They This is a website. It's called Trading View. I got the app for it. It's a free website, but it's just another tool basically. It's not just this. Like, they have this is just one part of it. They also have chat rooms, and they have different stuff on there. So that's a website if y'all want to try it, or if y'all want to get the app. It's called Trading View. But other than that, I think we covered a lot today. Unless y'all have any questions, what questions may y'all have?
Only question I'd have for the trading view, correct? Does that keep up to date with the market, like day to day?
Yeah,
Like, I guess on the hour or whatnot.
Yeah, man. This is based off of the 25th of April. So I mean, obviously it's only moving when the market is moving, but this is
Correct.
this is an up to date reference, if that's what you're asking.
Yeah, that's what I was asking.
And then, I mean, you could go back as well on all of them. Go look at different charts, see what it was doing 5 years ago. You know, because that's another way to look at it. The big thing to look at is the 50-day moving average and the 100-day moving average. And you don't even need the app for that. You could go to, I'm pretty sure you could go to Google and yeah, I researched it earlier. So S&P 500 moving average. And this one will tell you what the big indicators are. What's the moving average on the 5-day, 20-day, and again, the 5-day and the 100-day are the big ones. But this is another reference point just to make it a little bit easier. This is Bar Chart. This is another good website for analysis and stuff. They have interactive charts. You can look at ETFs. You can look at different. This is for the day traders here, the options and futures. But Then you could also look at different countries, like different markets, not just the American market. Uh, is that all you have?
Yeah, that was all I had, sir.
What about you, Lee?
So, question about bonds, sir. So, bonds are they more likely to like support the government more than like giving us gains? Is that to summarize that one, sir?
Currently, yes, because the yields are so low right now. Um, the yields are something else that you can track as well because they fluctuate, but they're currently like stuck below 1%. So yes, if you bought a bond with that yield, your money is secure because you know it's backed by the government. But at the same time, you're only going to get 0.88%, which is you're going to lose money because inflation averages between 1 and 2% every year. So that means the value of the dollar goes down between 1 and 2% every year. So if the value of your dollar is going down 1.2% and then you're only getting 0.88%, you're losing money by keeping it in a bond at this point. Because
Roger, sir.
money today is worth more than money tomorrow.
Roger, sir. So, in order to get like a more gain in long term, is it better to invest in stocks or is it better to like invest in bonds when you're reaching to that retirement point, sir?
Yeah. So when you're reaching the retirement point, you're older. You can't afford the risk, and when the market crashes, the the bonds they don't crash. If that makes sense. So, but there's still risk because again, Detroit is a perfect example of what could happen. Like, if y'all don't know what happened in Detroit, like the whole system broke. Companies started taking out they used to build companies, vehicles there, a lot of vehicles. It was called the Motor City. Um, but little by little, companies removed all their things at the same time. So all those people that worked in the factories, they all lost jobs. And little by little, it fed into the economy and destroyed basically the whole economy. Um, but that could happen. You know, people who had bonds there they got screwed. But in every situation, there's going to be people that profit and people that lose. So the people that profited off of that were the people that went and they bought houses for like $500. Literally, they had like online auctions where you could purchase a house for like $700. You could purchase a house for $500. So it's pretty insane.
Roger, sir. So, is that the reason why we have to like keep in mind about the correlation, see like what companies like fluctuate with each other? Is that why we have to take a look out for that?
Yeah, man. It's just of not having. You want to diversify. So if you have two companies that are doing the same thing all the time, you're not diversified in that aspect. Um, so you can have two, but you just don't want your whole portfolio doing the same thing at the same time.
Mm-hmm.
So, yeah, I mean, if you want two companies, like let's say you want AT&T and you want Verizon, you could have that, but just don't make your portfolio just made up of AT&T, Verizon, Sprint, T-Mobile. Then these are the only companies in your portfolio. You know what I mean? They're all going to do the same thing. They're all going to move up and down together.
Roger, sir. So, for investing wise, it's better to look at the zero correlation,
No,
or it
zero.
just depends.
If you're looking at correlation, zero means that they don't have any relationship with each other at all. So the ideal would be negative correlation. That means they're doing the exact opposite of each other.
Okay. Roger that, sir.
So when you brought up real estate, so for my next, obviously, like there's a real estate market, and then you were mentioning like they were buying houses for like 500 to 700 and stuff like that of the sort. Would, I'm sure you're like into real estate. Would you say right now is a good time to invest in real estate, or keep looking for it, or wait till like the real estate market is fixed and then go on about looking for homes and stuff like that of the sort.
Well, right now, man, I would wait a few more months. I would start researching now. Everything should be researched. But so what happened was the rates dropped, right? The government dropped the rates to zero. But the effect of that, what that caused was a massive buying. So even like Navy Federal, they had massive amount of refinances and they had a massive amount of purchases because people saw those rates and were like, oh my God, this is unbelievable. So they went and they purchased a lot. So because of the over purchasing, the banks and credit unions have been forced to like increase those prices again due to the fact that they can't meet the demand because they have so many people trying to do it. So even though the rates are extremely low, they actually the Federal Reserve dropped the rates, but you'll see. I'll show you in a second.
And then so with the people
Okay.
who saw those rates, right, and were like, oh, these are really good rates, gotta buy now. Was that a good decision on their part or bad? Because you said the rates also went up.
It all depends on when
Permanent.
it all depends on when they did it. So the
So if
rates
they
that
bought it while it was down,
yeah,
is that good on them?
the rates never even went down to the lowest point. Like before that even happened, they got boosted up. So now they're dropping again. But if you could tell right here, like these are the regular civilian type of loans. Like if you just wanted a regular civilian, uh,
Right.
these are really low, man, compared to where they were a few months ago. And I'm just talking about Navy Federal because I come and look at this every day because I'm trying to refinance my house, and I canceled my refinance because uh, I won't like they brought the rates to zero, so this is going to go down for the VA loan. But this went up, and these are coming down again because they went up to like 4% after they hit that massive demand. So they can't keep up with everybody trying to do it at the same time. Like they don't have enough people, especially with like a lot of their employees working from home. So these rates went like up to like 4% something, and I'm gonna wait till they come back down little by little, and I'm trying to get that like below 2% or close to 2% as possible.
So then when you're looking at the rates as well, for at least on our end, which one are we looking at? The APR as low as or the interest rates as low as? Or are we looking at both of those?
So it's they're the same thing, man. Just this includes everything in it. The APR, it doesn't. It's only interest. So the APR
Okay.
is the total annual percentage rate that you're going to be paying. So these two are the same, but this is just the basic, and this is APR. I guess later on, next week, if you want, we could discuss like more specifics into this, like talk about discount points, because
Yeah, absolutely.
this is something you're actually paying. But yeah, I mean, next week we could hit real estate and talk more specifically on that next week.
Yeah, I
Cool.
like that. Yeah, for sure, for sure.
All right. Diego, any final thoughts, questions, or
Nah, man, but that was good.
um, so let me stop this.
I got a question, sir.
Yep.
So when you pull up the screen about the 5 to 10 day and the 100 day and so forth, I was seeing like something like a change. So when we were looking at the 100 day or the 500 day, it was like showing up in red, but it shows like in significant high numbers, but saying it's minus. So I was just wondering, what's the definition about that, sir?
Yeah, let's open it up. Was it? Is it this one? No, I think I know what you're talking about. This thing keeps blocking my view. Hold on. I'm trying to pull up what you're talking about, Lee. Hold on.
Roger, sir.
So, what's your question, Lee?
Sorry, sir. So just looking at the chart, so I'm seeing like the 5-day, 20-day, and 50-day. So it's like in green. Wait. So there's a little bit of a minus, but it's showing green. But when we get slowly to the 100 and 200-day, it's showing up red. It shows a lot more than minus, but the numbers in the moving averages is like a lot higher
Oh yeah.
than.
So the reason is that the average at the 100-day, this is what the average is, 3,000. The reason it's red is because right now we're here, so we're currently below that. So anywhere where we're below, it's going to be red. Anywhere we're above, it'll be green. So we're above the 5-day, we're above the 20-day, we're above the 50-day, but we're below all three of these. So year to date means starting January 1st of this year. Even then, we're low. And this just tells you the difference between where we were and where we are. That's why it's in red. Does that make sense? These
Not
red,
really, sir. So I'm just a little bit confused because we're looking at the 2836 and looking down here to year to date, it's like higher. Oh, wait a minute. So we're just comparing on the year to date on the numbers, not what we have here. But currently we're on the 2836,
we're
which is
lower.
lower.
Yeah,
Oh,
so
okay.
that's why they're all red. This shows you right here the dollar value, what that dollar value means, how much lower we are in dollar value, and this just reflects to the percentage wise what that percentage means.
Hmm.
Does that make
Makes
sense?
sense, sir. Yes, sir. Makes sense, sir. Thank you, sir.
All right, no problem, Lee. Uh, anything else?
No,
Nope. Good,
I don't
man.
have anything.
Y'all good? All right. Thank you for your time. Hope y'all got something out of it. Appreciate it.
Thank you.
All right, man.
Peace.
Y'all have a great day.
You
Thank
too,
you,
sir.
sir. You too as well. Well,
Yeah.
gentlemen.
Take care.